Discover the secrets of the master of investments, Warren Buffett, and unravel the unique strategy behind his financial success. In the competitive world of investments, Buffett teaches us to avoid the fierce race for opportunities by revealing where to fish when the competition is lower. Learn why he advises focusing on smaller companies and how to identify truly exceptional opportunities. This is a deep dive into Buffett's brilliant mind and his exclusive investment strategy. Don't miss out. Sign up now to receive the upcoming valuable tips on the Warren Buffett investment strategy. Be part of our channel and enhance your skills in the world of investments.
5. Warren Buffett suggests that with a small amount of money, it is possible to achieve significant returns, but as the investment amount increases to millions, the potential for high returns decreases dramatically. Warren Buffett, a renowned investor, shares valuable insights into investment growth. He emphasizes that operating with a modest amount can lead to substantial gains. However, the landscape changes when the invested capital reaches millions, at which point the potential for significant returns tends to decline sharply. In the early years of his career in the 1950s and 1960s, Buffett adopted a more flexible approach, focusing on identifying undervalued stocks without necessarily prioritizing competitive advantages. As his capital base grew, he evolved towards the strategy of investing in excellent and undervalued companies with favorable long-term economic prospects. Furthermore, Buffett emphasizes the importance of avoiding intense competition in the investment world, arguing that the presence of talented and ambitious individuals makes the competition difficult. He compares this dynamic to fishing, suggesting that finding less frequented locations is crucial for investment success. In contrast, he warns that as the invested amount increases to the millions, the competition becomes more intense, compromising the search for profitable opportunities. Buffett also highlights the relevance of focusing on smaller companies. Large investors managing substantial amounts of money face challenges when trying to invest in smaller market capitalization stocks. Therefore, he encourages investors to explore opportunities in smaller companies, where competition is less fierce, providing room for valuable discoveries. According to Buffett, this strategy aligns with maximizing the potential for return.
4. In the early years, 1950s to 1960s, Buffett focused on finding undervalued stocks without much attention to competitive advantage, but as his capital grew, he shifted to investing in excellent companies. Warren Buffett, iconic investor and philanthropist, outlines a unique approach to investments that unfolded throughout his remarkable career. In the 1950s and 1960s, the early stages of his involvement, Buffett concentrated his efforts on identifying undervalued stocks, prioritizing less emphasis on competitive advantage. This initial period was characterized by a more flexible strategy, focusing on market opportunities without the same emphasis on the competitive characteristics of companies. As the wealth under his management thrived, Buffett adjusted his investment approach, transitioning to selecting excellent companies with favorable long-term economic prospects. The paradigm shift proved strategic, reflecting the investor's adaptation to the growth of his capital. This strategic realignment, occurring throughout his professional journey, illustrates the maturity of his vision and the ability to adjust tactics as circumstances evolved. Additionally, Buffett emphasizes the importance of avoiding intense competition in the investment world. Commenting on the competitive nature of the market, he compares the investment process to fishing, arguing that finding less explored locations is crucial for success. The investor highlights that, as the invested capital increases to millions, competition intensifies, making it more challenging to identify lucrative investment opportunities. In his journey, Buffett underscores the relevance of focusing on smaller companies. He points out that large investors, managing substantial volumes of resources, face difficulties when trying to allocate capital to smaller market capitalization stocks. This perspective highlights the need for investors to explore opportunities in smaller companies, where competition is less intense, providing a conducive environment for valuable discoveries. This strategy, as advocated by Buffett, aims to optimize the potential for return by aligning with the peculiarities of the financial market.
3. Buffett recommends avoiding competition, emphasizing that the investment world is filled with intelligent and ambitious people, making it challenging to compete. Fishing where there is less competition is crucial for success. Warren Buffett's investment philosophy emphasizes the importance of avoiding fierce competition in the financial world. The renowned investor highlights that the investment community consists of sharp and highly ambitious individuals, creating a challenging environment for competition. In a relevant analogy, Buffett compares the act of investing to fishing, emphasizing that the key to success lies in choosing less explored locations where competition is less intense. Buffett's fishing metaphor reveals a strategic approach to seeking investment opportunities. Just as a fisherman seeks less frequented areas to maximize catches, a wise investor should explore less explored market niches where competition is more subdued. This perspective underscores the need to analyze less explored sectors and find opportunities that may not be immediately visible to the majority of market participants. By mentioning the difficulty of competing in a saturated investment scenario, Buffett highlights the relevance of a strategic and calculated approach. The search for less explored sectors and companies represents not only a tactic to avoid competition but also a strategy to identify assets with significant appreciation potential. In this way, the prudent investor can find promising investment opportunities by moving away from excessively contested areas. In summary, Buffett's guidance on avoiding competition in the investment world serves as a crucial reminder to investors. Seeking less explored niches can not only mitigate competitive challenges but also reveal valuable opportunities that escape the attention of most. This strategic approach, grounded in the experience of one of the world's most successful investors, offers valuable insight for those seeking to maximize their returns in the financial market.
2. Focusing on smaller companies is advisable, as large investors managing substantial amounts face limitations when investing in smaller stocks due to portfolio size. Warren Buffett's guidance to focus on smaller companies reveals a keen understanding of the investment landscape. The investor advises that large asset managers, entrusted with considerable amounts of capital, face obstacles when seeking to invest in smaller market capitalization stocks. This perspective highlights a fundamental dynamic in the financial market, where the significant size of portfolios of large investors imposes restrictions on the search for opportunities in smaller companies. Exploring the logic behind this recommendation is crucial, understanding that investing in stocks of smaller companies provides a strategic advantage. The less congested market space in these categories allows investors to circumvent limitations imposed by portfolio size. Additionally, smaller companies often offer fertile ground for valuable discoveries, as their visibility may be reduced compared to their larger counterparts. Buffett's emphasis on the need for investors to explore opportunities in smaller companies aligns with a prudent approach to maximizing return potential. The investor highlights that by steering away from overly competitive sectors, it is possible not only to bypass limitations imposed by portfolio size but also to identify assets with a higher potential for appreciation. This strategy proves to be a thoughtful response to market complexity, demonstrating how seeking opportunities in less saturated spaces can translate into substantial gains. In summary, Warren Buffett's recommendation to focus on smaller companies goes beyond a mere suggestion. It becomes a relevant strategic principle in the field of investments. The ability to circumvent limitations inherent to portfolio size, combined with the willingness to explore less explored sectors, represents an intelligent and grounded approach to achieving lasting success in financial markets.
1. Buffett advocates for a concentrated approach, advising investors to focus on a few wonderfully understood companies instead of maintaining highly diversified portfolios. He highlights the importance of being ready to seize truly excellent investment opportunities when they arise. Warren Buffett's philosophy regarding concentrated investments offers a unique perspective in the financial realm. The respected investor advises that investors direct their attention to a limited number of remarkable and deeply understood companies, contrasting with the common practice of maintaining highly diversified portfolios. This recommendation reflects a strategic vision, where the quality of understanding and intimacy with the company's operations play a fundamental role in investment decision-making. Buffett's emphasis on concentration not only suggests a more selective approach but also underscores the need for investors to be prepared to identify and seize exceptional opportunities. The willingness to act promptly in the face of truly outstanding investments is a crucial component of this strategy. Throughout his career, Buffett has demonstrated that the ability to recognize and capitalize on unique opportunities can be as relevant as diversification itself. The guidance to focus on well-understood companies implies a deep involvement in the investment research and analysis process. Buffett, known for his rigorous scrutiny before investing, suggests that intimate familiarity with the internal workings of companies is an essential foundation for a successful concentrated strategy. This approach, although requiring a deeper understanding, seeks to maximize returns rather than dispersing them through excessive diversification. In summary, the concentrated approach advocated by Warren Buffett goes beyond asset selection. It is a philosophy that emphasizes quality over quantity and readiness to identify exceptional opportunities. The experienced investor highlights that by staying focused on well-understood companies and being prepared to act on exceptional opportunities, investors can shape investment strategies more aligned with growth potential and return maximization.
As we explore Warren Buffett's valuable lessons on investments, we realize that success goes beyond traditional diversification. The strategy of avoiding fierce competition, focusing on smaller companies, and maintaining a concentrated approach proves to be a unique path to financial success. If you enjoyed these insights and are eager for more investment wisdom, don't forget to subscribe to our channel, leave a like if this content added value, and share your thoughts in the comments. Together, we will continue to unravel the secrets of the Warren Buffett investment strategy. Let's build a stronger and more informed financial community. Until next time, investors.